Hi, everybody. This is Peter Schiff. It is Tuesday, May 20th, 2014. Last week, the government released its official estimates of inflation, both at the wholesale and the retail level. The May Producer Price Index, PPI, increased by 0.6% for the month of April. That's the biggest gain in about a year and a half. If you look at the year-over-year increase in wholesale prices, it's 2.1%. The increase in April was led by a surge, 2.7% in 1 month. That was the increase in food prices at the wholesale level. The retail inflation was a bit more benign. The CPI for April was up 0.3%. Year over year, it's exactly 2%. So we got retail inflation, 2%, wholesale 2.1%. As far as the Fed is concerned, this is like the holy grail of inflation. It's inflation nirvana because they're always saying our goal is 2%. Well, that's exactly where we are, at least according to these measures. Now, again, they're not really measuring inflation. They're measuring an effect of inflation, which is the increase in prices. Now, is the Fed going to declare victory over the phantom menace of deflation? Are they going to tighten monetary policy now that we're 2%? Not a chance. Now, I think we're going to continue to see these numbers increase, and we're going to be moving north of 2%. Now, at one time, the Fed was threatening to raise interest rates if inflation were to get above 2%. That ain't going to happen. It's going to go the way of the 6.5% unemployment goalpost. Remember, they moved that one as soon as we approached it. I think they're going to do the same thing with the inflation goalpost. There's no way the Fed is going to raise rates no matter how much higher than 2% inflation goes. The trick is going to be for the Fed to continue to persuade us that all of this is good news. Right? But they're going to have a lot of help from the media, which is really the purpose of this video blog, is I want to go over the media's spin to what really should be reported as bad news. You know, surging food prices, I don't care how you slice and dice that, that's not good news. Right? The fact that Americans have to spend more money on food, who's going to think that's good news? In fact, the more money you have to spend on food, the less you have to spend on other things. I mean, food is a necessity. We don't want to spend more money on food. We want to spend less money on food. That way we can have more things. We have more money to buy other stuff, the luxuries of life. We don't have to want to spend everything we earn on the necessities. But listen to the coverage. And I'm, focusing on 2 articles. But this is typical of the coverage that was out there. This is a Bloomberg story. And, Bloomberg, they write some of the worst economic stories out there. You basically have to flunk and examine basic economics to be a business reporter at Bloomberg. Here is the title of this story. Wholesale prices in the U.S. climbed by the most in more than a year. Prices paid to American factories and service producers rose in April by the most in more than a year, indicating a diminished risk of deflation as demand improves. In other words, this is good news. The fact that prices climbed the most in over a year shows that there's a diminished risk that those prices might have fallen. So what? How is that a risk? How is wholesale prices going down a risk? If I'm a businessman, wholesale prices are my costs. Don't I want my costs to go down? Wouldn't that be a good thing if the expenses of running my business went down? That's a great thing because it means I have a greater profit, or it means I can pass on those lower costs to my consumers in the form of lower prices. And if I can give my customers lower prices, they'll buy more of my stuff and I'll make more money. Businesses always want to lower prices. They don't like it when they have to raise prices because they know they might lose some business. So how is an escalation in the cost of wholesale goods good news for businesses? And how is the possibility that your cost of goods may have fallen, how is that a threat that has now been diminished? And now we can all breathe easy because we don't have to worry about our input costs going down. See, this is nothing but government regurgitated propaganda. It's nonsense to believe that rising costs are good, rising prices are good. Let me continue this story. The 0.6% increase in the producer price index was the biggest since September 2012 and exceeded all estimates in a Bloomberg survey of economists. Over the past 12 months, costs climbed 2.1%. Food prices surged by the most in 3 years. Again, why is this good news? The article writes, the gain in April was broad-based, from goods such as poultry and trucks to services like transportation, and indicates a rebound in pricing power could be taking shape as the world's economy improves. Right? Great news. Rising costs will probably ease concerns among the Federal Reserve policymakers who said that they want inflation to increase closer to their 2% goal. Well, we're already there. In fact, in producer prices, we're slightly above it. Wholesale food expenses increased by 2.7% in April, the biggest jump since February 2011, led by an 8.4% surge in the cost of meats. That was the biggest since 2003. So the biggest increase in the price of meat since 2003, and this is good news. Remember, Bloomberg is attributing the increase in prices to an increase in demand. See, the spike in prices is supposed to reflect a stronger economy because there's more demand. So you want us to believe, Bloomberg wants us to believe that there's more demand for food, that Americans are now eating more? Like what? We were going hungry a few months ago, a year ago. Americans were just not eating. We were starving. But now all of a sudden the economy is coming back, and so we're plowing into the supermarkets and we're buying all this extra food. We're just grocery shopping like crazy. And because of all this grocery shopping, the price of food is going up, and it's all because of a great economy? No, Americans aren't eating any more food. In fact, they're probably eating less food because it's getting more expensive. No. We're simply paying more for the food that we're eating. That doesn't evidence a good economy. See, if the economy was good, our farmers would be more productive. We would be producing more food, reducing the price of food. So Americans could eat more and pay less and have more money left over for the luxuries of life. But no, now Americans are forced to pay more for food. They're also forced to pay more for electricity and energy and insurance and all sorts of things. Education, healthcare, prices are going up for those basic necessities. But to attribute it to economic growth or to say that it's somehow good news, there's probably a lot of Americans that aren't eating as much of the quality foods. Beef prices have gone up so much that a lot of people who used to eat steak are now eating hamburger. And a lot of people who used to eat hamburger, well, they're not eating meat at all. They might be eating chicken, but even chicken prices are going up, so they might have to give that up. And that's what's going on. This is not good news. But nobody really reported this as bad news. And here, let me give you an example, too, of the AP story that I read in the New York Times. Listen to the headline. Rise in U.S. producer prices suggests healthier inflation. Healthier. It's healthier because it's higher. So in other words, according to the AP, and I guess the New York Times, because they ran the story, the inflation we had before was not as healthy because it was lower. I wonder, maybe it was unhealthy. Or I guess it's unhealthy if prices are going down. It starts to get healthy as they go up, and the higher, the healthier, right? So now we have a healthy dose of inflation because the number has picked up. Listen to, I'm going to read a little bit again from this story. The prices that companies receive for their goods and services rose in April by the most in 19 months, a sign that inflation may be picking up from very low levels. A good sign, right? It's not a problem. The producer price index rose a seasonally adjusted 0.6% from March to April, the labor department said on Wednesday, after a 0.5% from February to March. April's increase was led higher by food prices. So they acknowledge it's food prices. How is this good? For what American? Who among us is happy that the price of food has gone up? Over the past 12 months, producer prices have risen 2.1%, the biggest 12-month gain in more than 2 years. The report suggests that inflation may be picking up after coming in below 2% for 2 years. This could reflect better economic health. Higher inflation is generally a sign of rising consumer demand. No, it's not. Higher inflation is a sign that we're printing too much money. We're doing too much QE. You know, if we really had a healthy economy, again, we would be a more productive economy. And the more supply that is produced, the lower the price. The lower the price, the more things consumers can buy, the higher their standard of living. When prices are going up and our incomes aren't, our standard of living is being diminished, especially when the prices that are going up are for necessities like food. Nobody wants to spend more money at the grocery store. People aren't happy about the fact that when they go to the grocery store, they're coming home with less stuff for their money or lower quality stuff, or they're having to bring more money to the grocery store, and so they have less in their bank account when they finish their grocery shopping for the other expenditures that they have. Yet all these articles are fixated on this as being good news, right? Because they've been told repeatedly by economists and by bankers that the threat is deflation, or more recently, lowflation. That if we don't have enough inflation, somehow that's detrimental to economic growth. And everybody believes this. It's so widespread. I was at the Skybridge Alternative Asset Conference last week in Las Vegas. I spoke there on Wednesday, and I was on a panel. And one of the guys on the panel, seated immediately to my right, was Nouriel Roubini. And I spoke before Roubini did. And one part of what I discussed, Roubini commented on, and we had a heated back and forth argument. And I pointed out that the central bank fixation with deflation or low inflation or falling consumer prices was misplaced. I said that consumers and economies have nothing to fear from low inflation. In fact, we have nothing to fear from falling prices. That falling prices are not a threat to consumers. They are a boon to consumers. They ease their pain because that's what we want. We want relief from higher prices. Lower prices are a good thing. And Nouriel Roubini immediately took exception to my remarks and said, Peter Schiff is wrong. He's crazy. This is nonsense. We need inflation. We can't have falling prices. Falling prices are terrible. And he mentioned these two myths that are constantly brought out by the inflationists as to why we need inflation. One of them was that, well, if prices aren't rising, consumers won't spend. Consumers won't buy things because if they expect lower prices in the future, they'll hold off waiting for lower prices. And so consumers will be sitting on their hands, nobody will buy, and the economy will grind to a halt. Right? Now, this is complete nonsense without any evidence in fact. Right? Now, I pointed out to Roubini, I said, well, what about cell phones? Right? If what you're saying is true, nobody in this room would have a cell phone because we all know that cell phone prices are going to fall, yet that doesn't stop us from buying them. They've been falling for 20 years, and people keep buying them. The same can be said for television sets or computers. And Rubini tried to say, well, technology is some kind of exception. Well, really? Well, what other price would there be? Because I asked Nerio Rubini to give me an example of a single product that he believes a consumer would refrain from buying because they thought that product would be cheaper by 1% a year in the future. He couldn't come up with a product. I asked him several times. I asked him in private. I asked him on CNBC. They interviewed us on Fast Money later that afternoon. He couldn't come up with one. I mean, think about it. Food? Would consumers go hungry if they thought the price of food was going to be lower next year? Of course not. And in fact, would falling food prices be detrimental to the economy? Would anybody say that? Would it be a negative for the economy if food was less expensive? Certainly, the poor people who spend a disproportionately high amount of their income on food, wouldn't poor people really benefit from lower food prices? Who can argue that higher food prices are good for the poor? What about electricity, gasoline, your utility bill, your heating bill? Do you mean to tell me that if gas prices were to come down, that's a bad thing? That threatens the economy? That threatens the consumers? Don't we all want gas prices to come down? Don't we complain when the price is going up? So falling gas prices are bad? I mean, is somebody going to say, well, I guess gas is an exception and food is an exception? Okay, what else? What about medical care? Would it be a disaster if the cost of medical care went down? Aren't we complaining how expensive it is for health care and health insurance? What if prices went down? Would that be so terrible? Well, what about for insurance in general? If your auto insurance went down, your fire insurance went down, are these bad things? Should the government try to prevent these prices from coming down? Try to come up with a thing. Clothing? I mean, we all need clothing. And would it be a bad thing if clothing was less expensive? How about tuition for college? Everybody's complaining about rising tuition. What if next year college tuition was cheaper than this year? Would that be a disaster for the economy? No. I mean, you cannot name one price where if it went down, it would be a bad thing. And you can't come up with one product that somebody isn't going to buy because they think it might be slightly cheaper if they wait a year. Who wants to wait a year? If there's a product that you want and you can afford it and you need it, you buy it. Yes, you're going to shop around. You're going to try to get the best price that you can that day because you don't want to overpay, but you want what you want now. The only people who see a product and they want it and they need it or they want it and they don't buy it because they want a lower price is because they really can't afford the current price. Or maybe they want it, but they don't want it enough to pay the current price. They might buy it in the future if it gets cheaper, but at the current price, they don't want it or they can't afford it, right? But that's a different story. And if you're not buying a product that you want because the price is too high, what's the only way you're going to buy that product? Other than, winning the lottery or getting a big raise, you need the price of that product to come down. And if it does come down, maybe you'll buy it. If the price goes up, you'll never buy it. If you can't afford it at the current price, how are you going to afford it if the price goes up? And, another part of the proof, which I mentioned to Rubini, is the fact that so many Americans use credit cards, right, to buy stuff. Credit cards have interest of like 18%. Yet an American will whip out a credit card, buy something for $100, put it on a credit card, and pay $18 in interest over the course of the year, and then, pay for the product. If Americans are so concerned about getting a better deal, waiting for a lower price, why don't more Americans just leave their credit cards in their wallet, and when they see something they want, put money aside every month and save up for it, and then buy it in a year and save that 18%. Why don't they do that? Because they don't want it in a year. They want it right now. So Americans are willing to pay huge premiums to have stuff today rather than wait to get it cheaper in the future. There is no evidence whatsoever that Americans will stop shopping if they think prices will fall, or that falling prices are bad for the economy. In fact, if you talk to one of these people and you mention, as I did, every single item, they'll have to say, yes, it would be better if the price went down. Well, then why isn't it better if all prices go down? That's the other false logic, that Rubini threw out there. The other thing Rubini said is that, well, we can't let prices go down because prices went down during the Great Depression. And, well, we don't want another Great Depression. So, in other words, according to Rubini, because prices went down during the years of the Depression, that falling prices are somehow responsible for that depression. And if we ever have falling prices again, we'll have another depression. There's no logical way that you can make that conclusion. We had falling consumer prices during the 1920s too, yet we had a boom. We had falling consumer prices for most of the 19th century and the early 20th century, and the economy was growing faster than it's growing now. So you can't say just because we had falling prices, consumer prices in the Depression, that those falling prices were responsible for the Depression. I tried to point out that they provided relief during the Depression, that the Depression would have been far more depressing had prices been rising instead of falling. As bad as it was, it would have been worse. The same thing with Japan. Rubini says, well, they've had deflation in Japan, which they really didn't have. I mean, they had stable prices in Japan. They just didn't have inflation. And he said, well, they didn't have inflation and they had this lost decade. Therefore, we can't have low inflation because we'll be like Japan. There are plenty of examples where you have inflation and weak economies and low inflation and strong economies. In fact, if anything, going back to the example of the 1930s, the reason that consumer prices fell during the 1930s was a result of the forces that caused the Depression, although a lot of that was government related. But in the onset of that Depression, all prices went down. Asset prices, stock prices went down, real estate prices went down, wages went down. Prices had to come down. How could they not? The price of everything was going down. It would have been ridiculous if prices didn't go down. And what was ridiculous is we actually had politicians during the 1930s who were worried about falling food prices. That's why they destroyed agriculture. That's why they destroyed livestock, because they wanted to slow down the decline in food prices. Meanwhile, people were theoretically starving right during the Depression. Well, obviously not. If we had so much abundant food that we were destroying it, clearly people weren't going hungry if we were destroying our food. But falling prices were not the problem. Maybe prices fell as a consequence of the Depression, and that was a good thing, because had prices not fallen as a result of the Depression would have been worse. Rubini was trying to make the argument that wet sidewalks cause rain. But so many people believe this nonsense, particularly in the press, because I was reading this article in the Financial Times that covered the SALT conference and mentioned my little argument with Rubini, right? And the title of this article was "Hedge Funds Haunted by Deflation Specter," right? And the point of the article is people are, worried about deflation. And the article has a paragraph that reads, "Deflation should give everyone night terrors, since it begets a spiral of declining prices, soaring debt burdens, and weakening demand." Well, again, falling prices doesn't weaken demand. It strengthens demand. I can buy more stuff if the price goes down. Did falling prices destroy demand for cell phones? No. It created demand for cell phones. As the price went down, more people could afford to buy them. The same thing happened with television sets. The same thing happened with automobiles. Henry Ford brought down the price of automobiles with the Model T. It was the reduction in the price that led to the explosion in demand. It wasn't just a horseless carriage for the rich, right? It was transportation for everybody thanks to the reduction in price, right? Falling prices create demand. It doesn't destroy demand. But let me get back. Quote, "Deflation is the dark star, the black hole that collapses the economy," says Anthony Scaramucci, founder of Skybridge Capital and chairman of SALT, who happens to be a relatively nice guy. He actually came up and gave me a nice hug after my panel because I think he was happy about some of the reaction, getting everybody going. We were the first panel at the conference. But listen to the way this guy, Stephen Foley, who wrote this piece for the Financial Times, listen to how he brings up my discussion. Here, quote, "There was an amusing moment early on at the conference when Peter Schiff, chief executive of Europe Pacific Capital, tried to argue that falling prices would be good for the consumer." See, it was amusing, right? It was funny, laughable that somebody can try to argue something as ridiculous. See, I didn't even argue it. I tried. See, but I failed in my attempt. I tried to argue this, right? But then I was slapped down. Right? I was bitch slapped. I was slapped down by my fellow panelist, Muriel Rubini, who called this sanguine view of deflation nonsense that flew in the face of all economic history. It doesn't fly in the face of any economic history. It's Rubini's nonsensical claim that falling consumer prices is bad for the economy that flies in the face of reason and logic and evidence, both historic and present. I mean, where was this guy? He obviously wasn't paying attention to the audience. He didn't slap me down. I slapped him down. I got more applause than he did. I think there was more common sense in the audience when I made my points than when Rubini tried to defend what really is an indefensible point, to try to argue that consumers are served by higher prices. I mean, listen to this article. He doesn't even talk about the economy. This guy says, I tried to argue that falling prices would be good for consumers, but I was wrong. It was laughable. So consumers actually benefit when the price of the stuff that they consume goes up. See, people don't even know that. I mean, people are always looking for a deal. They're shopping for a better price. They don't realize they're acting against their own self-interest. If they are only smart as economists, if they only knew that if they just paid higher prices, they'd all be better off. Why are merchants having sales? Don't they understand what their customers really want, even though they don't know it, is higher prices, not lower prices? See, this stuff is what's nonsense, not what I'm advocating. What I'm advocating is common sense. It's common sense that lower prices are good, that increasing production so that more people can have more things is good, especially if you're talking about the poor or the middle class. Look, if you're Warren Buffett, you don't care what stuff costs, doesn't matter. You probably don't even ask for about what the price is. If you see something and you want it, you buy it. Doesn't matter what it costs. You have more money than you could possibly spend. It's people living on a fixed income, people who have a low income. They're the ones that have to look at the price tags. They're the ones that have coupons. They're the ones that, comparison shop. So lower prices benefits the vast majority of Americans, and it benefits the economy. It leads to a rising standard of living. Who benefits from inflation? The governments. Why do the governments benefit from inflation? Number one, because they've got a lot of debt. And hey, inflation always benefits the debtor at the expense of the saver, the lender. This has been an argument that's been going on for centuries. Debtors want inflation because they don't want to have to repay their debts. They want to get out from under their debts. It's like a default. Creditors want sound money. They want to get repaid money that's worth at least as much as they loaned out. So since governments are the biggest debtors, yeah, they want inflation because they don't have the integrity to honestly default, to admit that they borrowed beyond the capacity of the voters, the taxpayers, to repay. So they want a get out of jail free card. They want inflation. They also want inflation to create the illusion of prosperity because inflation makes people feel richer because the numbers get bigger. The stock market gets higher, maybe your paycheck gets higher, the GDP is bigger, so we think we're richer. They also want inflation to bail themselves out of bad policies, like the minimum wage. Right? The politicians want to raise the minimum wage, but now they have to reduce the value of the wage so too many people don't lose their jobs. So they can publicly raise the minimum wage, and then they can secretly lower its value by creating inflation. They also have to sustain asset bubbles. They want to keep the stock market up. They got to keep the real estate market up. They got to create inflation to do that. So they have to create an environment that is favorable to inflation. So it's all about what benefits government. None of this benefits the economy. It all works to the detriment of the economy. When the Fed has to misdirect assets to sustaining bubbles, it misdirects that capital away from the more productive uses to which it would otherwise have been employed. Instead of being invested productively in the real economy to increase our productivity, it gets diverted to sustaining bubbles. We have reckless speculation instead of legitimate investment and wealth creation. We finance government deficits, but this government spending is a drag on the economy. So all of this is a negative, right? But the government needs to create the environment where inflation is somehow coveted, somehow seen to be desirable. Because we're going to get inflation, and the government has to find a way to convince us that it's good for us. The interesting thing is going to be seeing how they handle it when it's too much of a good thing. At what point are they going to admit that inflation is good? You know, Nir Rubini, when he was on the CNBC interview with me, and he said, look, I don't believe in high inflation. I want 2% inflation. And I said to Rubini, well, why is 2% inflation good? I mean, why is it better than 1% inflation? He couldn't answer the question. I mean, what is so special about 2%? If 2% is good, why isn't 3% better? Right? There's no explanation. See, I'm consistent. 2% inflation is bad. 3% inflation is worse. 1% is not as bad as 2%, but it's worse than 0. And falling prices, if prices go down by 1%, that's better than having them remain the same. I have a consistent view. But according to the Keynesians, if inflation is too low, it's bad. If it gets up to 2%, then it's fantastic. And if it gets above 2%, it's bad again. So it goes bad, good, bad. How? I mean, who told the economists that 2% was the magic number? But it's going to get worse. And what is the Fed going to do about it? Because the problem is, no matter how high that inflation number gets, they can never admit that it's a problem. Because if they admit that it's a problem, they got to do something about it. But they can't do anything about it. Because if they want to fight inflation, what tools do they have? Just one, right? They've got to raise interest rates, which means they got to end quantitative easing. And in order to raise interest rates, they got to start selling their bonds and their mortgages back into the market. That will collapse the real estate market, collapse the stock market, send the economy into a sharp recession, and bring about a financial crisis worse than 2008. So because they can't do that, they can't do anything. So they are going to have to tolerate inflation no matter how high it gets. They're going to have to convince us that it's good for us no matter how high it gets. They're going to say, oh, well, maybe it's transitory. It's because of the weather. Oh, you know, we had such low inflation for so long. We need a few years of higher inflation to even it all out. Who knows what kind of excuses Janet Yellen is going to come up with to rationalize why whatever the inflation number is, no matter how high it is, it's always going to be a good thing. But I wonder if the media, if the guys at Bloomberg or the guys at the New York Times or the AP or the Financial Times will ever see through this charade. Will they ever see through the smoke screen and come out and call the Fed out on this? Will they ever say, you know what? We got too much inflation. This is not good. Do something about it. And when the Fed doesn't do anything about it, that's going to be a big problem for the dollar. Because that's when people realize that this is QE infinity, that inflation is never going to stop, that the dollar's value is going to erode away in perpetuity. That's when the bottom drops out of the market. That's when the real crisis comes in. Because now the dollar really starts to cave. That puts more pressure on the bond market. That means the Fed has to print a lot more money, right? A lot more dollars that nobody wants to buy the treasuries that nobody wants to keep the market from collapsing. That accelerates the inflationary spiral and puts the Fed in a real box. Because then it can't just print the dollar into oblivion. It can't turn it into monopoly money. Then it has to slam on the brakes. Then it has to really jack up interest rates. Not just a few hundred basis points, 10%, 15%, 20%, Paul Volcker style. Of course, the medicine won't go down nearly as smoothly as it did back then. Not that it was so great tasting. We had a pretty bad recession in 1980, but that's nothing compared to what we're going to go through because we have a lot more debt now than we had then. It's not even close. We don't have the viable economy. We don't have the trade surpluses or the current account surpluses, and we don't have a federal government that has a long-term financing on the national debt. It's all financed with T-bills, and we have all these adjustable rate mortgage. We have all these corporation individuals that are so levered up. We've got all these student loans and credit card debt. We have all this stuff that we didn't have back in the 1980s that we're going to have to deal with thanks to the Fed. That's all for now. Again, to get more frequent updates on what's going on in the economy, in the markets, the Peter Schiff Show is weekdays, 10 a.m. to noon Eastern Time, Monday through Friday, schiffradio.com. Don't forget to tune in live, call in, and if you can't listen live, listen whenever you can because we constantly repeat the most recent show until the next show takes its place. Bye for now.